Look at this time lapse of a shipping port operating at full capacity. When we see container ships, moving trucks, and physical goods changing hands, we build a logical assumption. The stock market is a mirror of this physical reality. If output expands, prices should rise. If the economy slows down, prices should fall. Now, introduce a severe recession into that physical system. Consumer spending drops off a cliff. Factory output stalls. Corporate earnings drop by double digits as businesses lay off workers just to survive. This chart shows the paradox that routinely follows a collapse. The blue line, representing the physical economy, plunges, but simultaneously, the orange line, tracking the stock market, skyrockets. If the stock market consistently ignores the health of the physical economy, everyday citizens are misinterpreting the most prominent indicator of financial health we have. They are looking at a broken thermometer to gauge the temperature of the room. Let's flip the scenario. Imagine a national economy that posts a 5% expansion in gross domestic product. On paper, it looks like a boom. You would expect equity indices to rally, but instead, stock prices crash. The mechanism behind the crash is hidden in the price of goods. If that 5% surface growth is driven entirely by 10% inflation, the cost of doing business is rising faster than revenues. Businesses are losing ground, and their profit margins shrink in real terms. Curious, surface-level economic labels like growth or recession are decoys. The stock market appears disconnected because it is solving for variables that rarely appear on a factory floor. The first hidden variable is expectations. The market does not price assets based on absolute reality. It values them against established baselines. Imagine a company reporting its annual earnings. The numbers reveal a damaging 10% drop in total revenue. On this bar graph, we compare the reality to the expectation. The market had previously priced in a 15% drop. Because the actual 10% drop is shallower, the positive gap between those two numbers becomes a catalyst for a rally. Scale this logic up to national data. Rising unemployment numbers only trigger a market crash if the raw data is mathematically worse than the disaster scenario investors already factored into the price months ago. This establishes a core rule. Horrific economic news triggers a market rally whenever the reality is simply less bad than feared. The second layer is probability. The market never prices a single guaranteed outcome. It prices a weighted average of multiple possible futures. Look at three paths for a company. A strong recovery yields 120 units, a stable path holds at 100, a recession yields 70. Assigning probabilities of 30%, 50%, and 20% to these paths blends the futures together. Today's expected value settles at 100 units. If a minor piece of news pushes the odds of that top recovery path from 30% to 35%, the mathematical average rises. The underlying economy hasn't improved at all today, but the stock price climbs mechanically. Day-to-day market movements are rarely direct reactions to current events. They are micro-adjustments to the math of future probabilities. But the most powerful variable driving this divergence is the discount rate, the interest rate used to assign a present-day value to future cash. Consider a severe contraction. Consumer spending drops, and corporate earnings fall from 10 to 6 per share. Central banks recognize the crisis. To provide a cushion, they drop borrowing rates from 6% down to 1%. This illustrates the reverse effect of cheaper money. As the discount rate slider moves from 6% down to 1%, future earnings are penalized far less. Even though the company makes fewer units of profit, the present valuation bar expands, dwarfing its previous height. In a crisis, the stock market rises because of the monetary rescue package. The flood of liquidity overrides the reality of the recession. We are looking at two distinct time horizons. The lived economy operates in the present tense. It is measured by weekly wages, current factory output, and immediate job stability. The market system is an abstract structure. It is driven by what corporate cash flows will look like 5 to 10 years from now, and the availability of liquidity today. When a piece of incoming data hits both systems, like a spike in national unemployment, it triggers opposite reactions. For the everyday worker, the unemployment spike signals immediate distress. But for the investor, it signals an incoming drop in interest rates, creating a buying opportunity. The stock market solves for what reality will look like 5 years from now, filtered through the cost of the money used to get there. It is not a mirror, it is a probability-weighted model of the future.